360P, remembering it is always, sadly, easier to buy when the market is high than when the market is low. And we all know that intellectually that's backwards, but we also are humans, and that's how we tend to respond. All right, number 5. Oh, I love this one. Dimensional Fund small cap value was 31 on June 2007 and is 42 now. Over 16 years, this is a yearly return of 1.9%. Can you comment on that? Well, my first response is, wait a minute, that's in my portfolio. Did I miss something? Go ahead, Chris, if you want to take the first shot at it. And if not, I've got the numbers.
Yeah, what do your numbers show? It actually, is that the correct return?
It depends on how you look at the return. Do you include all the capital gains, all the distributions that they made? And
the reinvestment of dividends. So what is the return with the reinvestment of dividends?
9.7% over the last 15 years. The reason I went with 15 instead of 16 is because I go to Morningstar and that's updated every day. It is interesting to note that the average in that category over that same 15 years was 8.6. So I have welcomed the fund back into my portfolio when I found out that it hadn't compounded at 1.9%. But it is an interesting aspect of mutual funds. They are obligated to distribute and reinvest in most cases is what people ask them to do. So while the price didn't go up much, 1.9%, everything else totaled up to be another, what is that, 8%, I guess, approximately. So you're looking at something, I can see it in your eyes. What are you seeing?
Well, I'm just doing exactly what he did. So I'm going to Portfolio Visualizer and looking at the history from 2007, he said, right?
June, if you want to be.
Yeah. Oh, June of 2007. Okay. Let's look at exactly June of 2007. And we will reinvest dividends because that's what you should do, a lump sum back test. And what we get is a CAGR of 6.85%. So it's interesting, that is not an impressive CAGR, I would say.
Well, you know something? What happens is it means that the market started selling off the last part of 2007. You were picking up right from the top, if you will, and you're seeing what happened with the complete decline of 2008.
Well, and I think in his mind, I think in behind this question, he's saying, you're showing me a fund that for 16 years of time delivered 6.85% compound annual growth rate. Now, he quoted the 1.9 because he didn't include reinvesting dividends. But it was 9.06 for the S&P 500. And if I go back and I say don't reinvest dividends, which is the way he was looking at it, I think, yeah, so there you go. Okay. DFA's small cap value, the compound annual growth rate over that period of time, not reinvesting dividends, was 1.84%, and Vanguard was the S&P 500 was 7.02. So what I hear in here is that this is an individual who cares more about the price of his asset than he does the total return. And maybe there is some fairness in that because there's taxes on some of those returns that reduces their value. Yep. But the other thing I hear is that he's happy to make an investment decision on a particular 16-year period of time. And going back to my presentation, you really need to know what kind of an investor you are. Yep. If you're going to be swayed by this analysis, I think it may well be the case that you should invest in the S&P 500 because it's got a higher price return. It's something he's probably comfortable with. It's the benchmark he's using. and I should say he or she, I don't know. And they will likely be happy with what they have as an alternative. And I tried to be really, really forthright in my presentation and say that what you and I recommend and what we teach and what we advocate, although it has historically delivered a better return per unit of risk, it's not for everyone. There are people for whom just a target date fund will be a better solution, or just S&P 500 or S&P 500 plus 10% in short-term bonds because they trust Warren Buffett. That's fine. I have absolutely no problem with that. I think it's far more important that they do what fits them than that they do what is historically optimal. Because for most people, they'll stick with it. They'll stick with what fits them.
Yes, and to give even greater, wider perspective to how people feel, the people who were sitting there on July 22nd are comfortable with the idea of being in the market or wishing they were in the market in one case, okay? There were a lot of people who did not attend who have no interest in having any money at all in the market because they show another story that when you go into the market, you can lose a lot of money and more than you thought you were going to lose, at which point you cash in. They did it once. They're not going to do that again. They learned their lesson and they're never going back into the market. And we have the same problem with the S&P 500 going 10 years, making a compound rate of return of a negative 1%. What do you do with that in convincing people it's a great place to put their money? Well, the answer would be look to the long term. And when it's the S&P 500, I think it's easier for people to say, oh, yes, all those companies I drive by on the way to work, yes, I will know that I own part of those big companies. But when you say you should have money in small cap value, you don't drive by those companies as often. And so there's that peace of mind is what will allow people to put money into the S&P 500, even with bad performance, versus other asset classes they just don't know as well. So thanks for doing that work. Number 6, it seems that the underlying assumption of these long-term analyses is that your audience has a remaining lifespan long enough to linger in any specific strategy. I'm liking this comment. But probably most of this audience has already reached retirement age and are looking at a 30-year limit at best. Now, how many years? When you think about how long you're likely to live, legitimately, what do you put on your life as an estimate how many years you could be around?
I think I've still got another 30 plus.
Okay, yeah. That's great. So wouldn't active market timing, this is what he goes on to say, wouldn't active market timing be a better strategy for our category when it comes to tweaking asset overweights and underweights? Also, how might one use stop loss rules to contribute to better returns? In other words, the bottom line is, why not be defensive and be a market timer as a way to deal with the reality that we have a relatively few years left?
Yeah, there are two thoughts that come to mind here. One is that you're in this situation, Paul, and you have always used some systematic market timing managed for you, done by the Merriman. What's the name of your company?
My former company, Merriman Wealth Management.
By Merriman Wealth Management. And they're one of the few companies, I think, that sells that systematic market timing as a service as part of their wealth management offering. And so I think you feel like that is a prudent solution to hire it out and have it done for you as a way to reduce your downside risk. It doesn't increase your upside risk or your expected return, but it does actually tamp down some volatility. So I don't think there's a problem with that, except that it's not very widely available. And so people would maybe struggle to find where to get it. I don't use it because I haven't chosen to go with your former company. And I think I have the stomach to tolerate the volatility of the portfolio we've right-sized it for. And the reason we don't recommend that as a strategy for do-it-yourselfers, you've said this many times, is that doing that kind of systematic implementation is very, very difficult on the emotions, because so many times the trades don't help you out. They actually are losing trades. And so it's easy to second guess it as you're going along. Unless you have a computer doing it for you in the background, most even professionals would second guess it. And so that's why for most do-it-yourselfers, I don't think it makes sense to try and do that kind of systematic market timing.
But there is some really good news from all of my experience. And looking at the evidence, the numbers, the compound rate of return over a long period of time with timing and buy and hold are virtually the same.
Yeah, they're almost the same.
I mean, and how does that happen? Because if you have a 70% equity, 30% fixed income timed account, you have about the same risk and about the same return as a 50-50 stock bond buy and hold. Timing reduces the risk. A lot of people think timing increases the risk. No, it reduces the risk, because when you're out of the market, you're sitting patiently, hopefully, in a money market fund or someplace that there is no volatility, while the buy and holder is always exposed to the volatility of the market. And as Chris said, I would never try to do this myself. I'm very comfortable having somebody else do it. I'm very comfortable being able to know that my wife and I, we are half buy and hold, half market timing, half big, half small, half value, we are half of so many things. People can't believe that it doesn't add up to more than 100%, but it is massive diversification, and it's what I'm comfortable with. I don't have to be any more aggressive. In fact, Vanguard would tell me, if you look at their target date funds, that at our ages, we should be no more than 30% in equities and 70% in fixed income. And I'm feeling like a young buck. We're 50% in equities, being more aggressive because we're investing for the next generation in part. So,
and the last part of this question about stop loss rules is stop loss. He's implying that you would set a trade that is going to sell a stock or a fund when it drops below a certain level to protect yourself in your retirement years, to protect your nest egg. It's a complicated way to do the same thing that right-sizing your risk in your portfolio does. You can just carry more bonds, and you can lower your downside risk in bad market times. And so I think, again, it's a personal thing, but for the vast majority of people, I think it'll be easier to unemotionally implement a buy and hold strategy that's got the right size of risk, rather than trying to do these complex solutions. And the downside of these complex solutions is that it's just far too tempting to fall into the wrong kind of market timing, which is performance chasing, where you go, oh, wait a minute, this thing's going up, that's where I should be, and then sell the thing that hasn't been going up. So today it would be maybe selling REITs, because REITs are down, to go get into growth because growth is up. And usually that's exactly the opposite thing to do to maximize your return in the long run. Yeah.
And I might add that being almost 80, let's say I've got 15 years. Well, 73 and 74 was a period where market timing could add value. Doesn't mean every market timing system will, but should or could have value. You then had to wait until 1987. And while we were fortunate to have our clients out of the market during that major one-day decline of 22%, the biggest market timer in the country, a guy named, oh my God, how embarrassing, I can't think of his name now. But he was in and got out on Monday after the huge decline. He was late, but that's because our systems were slightly different. And so when you look from that period of 73 and 74, with the exception of that one day huge decline, you have to go all the way to 2000 before you run into a need for market timing, which means that at age almost 80, I may not see a market that needs protection with market timing. In fact, there's a pretty good chance that I won't. But I probably will, but I might not. And so, do I quit market timing? No. Do I quit putting money into the stock market because it might collapse? No. But I got enough fixed income in there that if it collapsed for many, many years, it would not keep us from putting bread on the table. All right. I know we're talking longer than we expected. So, number 7, risk and reward of evaluated strategies. Where would the ultimate buy and hold strategy sit on the chart in terms of risk and return? Do you want to comment on that?
The lowest return, lowest risk strategy, but a good one, was the target date fund. And it was a 47% worst drawdown. And that happens during the accumulation years where you want it to. So the retirement years have less of a drawdown. It had a lifetime CAGR of about 5%. That's real. So that's above inflation. If your inflation across your lifetime averages 3%, that would have been an 8% return, quite respectable. And it had a safe withdrawal rate of almost 4% at 3.7. So it was good. The next strategy we looked at was 2 funds for life with a 90-10 split, 90% in the target date fund, 10% in small cap value. And it had a 4.1% safe withdrawal rate. So that's really nice. A 6.1% lifetime CAGR, real again. So that's before inflation. But to get the added return, you had to tolerate more risk. It took it up to a 54% worst case drawdown. Now, these worst case drawdowns were going all the way back to 1928. They happened 0.1% of the time. So this is a very conservative way to portray risk. Many lifetimes did not include that worst case drawdown. The 80-20 target date fund, small cap value 2 fund for life strategy improved the safe withdrawal rate to 6.8%, or I'm sorry, the CAGR to 6.8% and the safe withdrawal rate to 4.5%, but it came with much more risk, almost a 70% worst case drawdown. And then up here at the top right, you have the highest risk strategies. These were around 80%. There's a group of 3 of them that are just below 80 to just above 80% worst case drawdowns. And they had CAGRs of 6.7% real. That was the S&P 500, which had a 3% safe withdrawal rate. And then the 50-50 2 fund for life strategy, target date fund and small cap value, and worldwide 4 fund portfolios, both were around a 4% CAGR, both were around an 8%, an 8% CAGR and a 4% safe withdrawal rate. So where would the ultimate buy and hold sit on this chart? It would be about the same spot as these 2, about the same spot as the worldwide 4 fund and the 50-50 target date fund and small cap value split. I would expect it to have about a 4% safe withdrawal rate going back to 1928, and I would expect it to have about an 8% real CAGR.
Now, Chris, I got to tell you, I struggle. I struggle with showing this information going back to 1928. By the way, I fully support it. I think it is a full disclosure, but a lot of people are making decisions based on periods of time that would not include these catastrophic events. And so let's say that they are trying to make a decision, and part of the information they're getting is from people who are showing the last 50 years instead of the last almost 100 years. And so how different would it be if we pretended that terrible decline back in the 1929 through 32 period didn't happen, that the government can now control things better than they did in the past with all sorts of kind of stimulants and whatnot to try to prop up a falling economy. How different would this look if you look just at since 1970? And I don't need to see the exact figures, but just kind of generally.
Yeah, generally the drawdowns would probably be about 2/3 of the size, and the safe withdrawal rates would probably be a 0.5% or more greater. And that's one of the reasons I go back to 1928 is that all of the safe withdrawal research covers the 60s, which is where our safe withdrawal rates get set. That's where the worst experiences, the worst retirement experiences began. So to leave those out makes the safe withdrawal rate research or numbers incredible. It makes them unbelievable because people have anchored on these numbers that came from the 60s. So I think another way to look at it, and I'm going to do this in my AAII article that's coming up in a couple of months where I talk about safe withdrawal rates, is to look at what the likelihood is that you would live through one of these, drawdowns at different time periods or declines. And like I said, the likelihood of your experiencing the 80% drawdowns shown here is roughly 0.1% in any given month. So that's a very, very tiny percent. The vast majority of the time, the most likely outcome is that you're up because the markets tend to go up. But in terms of trying to figure out what risk you should take on, I do like to be conservative. I'd rather have people right size their risk for something that is a little more extreme than, I'd like them to believe that they're exposed to something maybe a little more extreme than what they're actually going to experience, so they don't take on too much risk. And so, yes, it's conservative. And yes, if you went back to 1970, it would be smaller.
Okay. But I think that the relative returns would be similar.
Yeah, the returns are quite consistent. They don't change that much. They do go up and down, but when you average out over a lifetime or 30 years or 20 years, they become it gets much narrower. Yeah.
Okay. By the way, I'm getting the feeling that rather than 16 questions today, we're going to get through 10.
We'll see where you tell me when to stop.
Okay. The next one, number 8, in a 401k, would it be better to pick an actively managed target date fund like T. Rowe Price for simplicity, or pick a 3-fund boglehead strategy, even though it's slightly more complicated? What do you say?
This is really up to the individual. It's really a personal choice. Neither of them seem complex to me. They both seem pretty easy. And I would encourage the person before they decide to consider a 2-fund solution rather than the 3-fund solution. I'd go in between and I would say, why not use a target date fund and some small cap value? Because then you get some of this more meaningful diversification. When you go, the diversification you get with a small cap value fund is much more meaningful than the diversification you get going internationally. So I would encourage them to look at that, but I think any of them are fine. They'd all be fine. You get more control with the 3-fund boglehead strategy because you can decide how much you want in the US and how much you want internationally and how much you want in bonds versus stocks, at a very granular level. But my personal favorite in there, I'd go with a target date fund. I'd rather use Vanguard than T. Rowe Price, although T. Rowe Price has outperformed in recent years. So, the T. Rowe Price hasn't done poorly. But I'd go with the small cap value combo with that.
And I guess as I look at the 3-fund strategy and remembering that I have to address these fine bogleheads, in October, and I'm bringing my tomato protective outfit to wear. I would probably be looking, rather than at the total market US and the total market international, which is what the 3-fund Boglehead strategy is about, plus a total bond market portfolio. I would, looking at in fact, I'm going to have a link here to, I believe it's table H1, where you can look at the S&P 500's return. There is no reason that I know that you would get a better return by having a combination of the S&P 500, of the total market index US and the total market index international. I think the S&P 500 itself will create almost the same return. What you would see is, you want to be a little more aggressive than what Chris has recommended here, is that a combination, if you want to be a do-it-yourself investor, a combination of the S&P 500 and small cap value, 50-50, over the last 53 years has exposed people to less risk of loss than the S&P 500. And so that's what I would be trying to get people to look at, and to look at every year. In fact, we'll also include the link to all of the tables about these strategies, so you can look at every year at a time since 1970 and look at that risk and return.
And Paul, when you present that, I think it's your opportunity to help teach Bogleheads something that I think some of them don't understand. Many of them probably do, but when you own the total market, I've heard them say, well, I own large, I own small, I own value, I own growth. I'm exposed to all of these things. The growth offsets the value. The large offsets the small. The only way you get meaningful diversification is by owning a disproportionate amount, by owning more than is represented in the market at large. So when you combine the S&P 500 and a small cap value fund, you tilt, you own a disproportionate amount. And that's what gives you the benefit of taking advantage of one zigging when the other's zagging, and they're performing a little bit differently to get a higher return per unit of risk. So I wish you great success with the Bogleheads.
Well, I will have that other table with me that shows small cap value on one side of the page, the S&P 500 on the other, and making 10% incremental changes in the combination. So somebody could say, hey, I like what Chris is suggesting, 10% or 20%, but let's see what happens when it's 30% small cap value. And you're going to be shocked at how little difference there is in the risk and how much difference there is in the return. If only the future could look like the past. Number 9, instead of a bond fund, why not a dividend fund that invests in companies that grow their dividends, like the Schwab dividend, U.S. dividend ETF, SCHD? Well, this one is an easy one, isn't it?
Well, my dad was a dividend aristocrats investor, and I really understand the appeal of being able to pick companies that have a history of delivering increasing earnings and distributing it back to their shareholders. And for my father in retirement, there was great comfort in knowing that there was going to be a steady stream of money coming in that meant he didn't have to tap the principal. And so I understand the appeal, but I want to read a little bit from Larry Swedrow's book here, Your Complete Guide to Factor-Based Investing. And I don't know if Andrew Birkin or Larry wrote this, but Appendix C says dividends are not a factor. And I'll just read a little bit here. In their 1961 paper, Dividend Policy Growth and the Valuation of Shares, Merton Miller and Franco Modigliani famously established that dividend policy should be irrelevant to stock returns. For more than 50 years, this theorem has not faced a challenge in the academic literature. Moreover, the empirical evidence supports the theory, which explains why there are no asset pricing models that include a dividend factor. Despite this long-held tenet of traditional financial theory, one of the biggest trends to occur in recent years has been a rush to invest in dividend strategies, such as strategies that invest in stocks with relatively high dividends or in stocks with a record of increasing dividends. The heightened interest in these strategies has been fueled by both by media hype and the current regime of historically low interest rates. The low yields generally available on safe bonds since the start of the Great Recession in 2008 has led many once conservative investors to shift their allocation from safe bonds to riskier dividend-paying stocks. This has been especially true for those who take an income or cash flow approach to investing as opposed to a total return approach, which we believe is the right one. And then he goes on to say that there's just no evidence that dividends are a path to greater long-term total returns, and that you should really focus on total returns. And the truth is, when you get a dividend, your stock price goes down by that amount, and you can watch it day to day. Somebody sends you a $2 check in the mail, you think, I got $2. Well, your stock price went down by $2. So, there's no magic there. And dividends are a forced tax, is the way I look at it. So I can see where it appeals. I don't think it's an imprudent strategy. I just don't think it's the best approach. And so we take a total return approach, both in the way we construct our portfolios and the way we invest personally.
And the bottom line is that the bonds have a certain, a small amount of downside risk, larger than people expected last year. We understand that. But built into that Schwab fund is the 50% loss in a big market decline. It is not a broadly diversified. It has 100 companies, and I believe 40 10 companies represent 40% of the portfolio value. So it doesn't have huge diversification that you would get in the S&P 500. But the key is it's not a defensive, except that if that dividend keeps coming, that's the reward that allows you to see the value go down by 50% because you believe that the companies are going to come back. And anyway, thanks for reading that. And as most of the people that follow our work know, we have a list of truth tellers that do not pay us to call them truth tellers, and Larry Swedroe is one of them. So, this one's way too easy. I'm going to skip one here and go to we'll make it number 10 here, Chris.
Oh, let's just take number 10 and do it as a bonus. It was super easy. It was how long a period of time is your short-term bonds? It was 12-month U.S. Treasury bills. So there you go. That was easy.
Oh, okay. Very good.
Yeah.
By the way,